Good evening, friends. Today we are going to discuss about the double entry system. It's a very important topic of the accountancy and total journal, ledger, track balance and balance sheet depending upon this important topic. So, double entry system. This system owes its origin to an Italian merchant named Luco Pacioli, who wrote the first book entitled De Computis Scripturis on double entry accounting in the year 1494. We have seen earlier, but every business transaction has two aspects. That is, when we receive something, we give something else in return. For example, when we purchase goods for cash, we receive goods and give cash in return. Similarly, in a credit sale of goods, goods are given to the customer and the customer becomes debtor for the amount of goods sold to him. This method of writing every transaction in two accounts is known as double entry system of accounting. Of the two account, one account is given debit while the another account is given credit with an equal amount. Thus, on any date, the total of all debits must be equal to the total of all credits because every debit has a corresponding credit. Rules of the double entry system. There are separate rules of the double entry system in respect of personal, real and nominal account which are discussed by us today. So first account is personal account and second is real account and third is nominal account. So we are going to discuss first this personal account. These accounts record a business dealing with persons or firms. The person receiving something is given debit and the person giving something is given credit. For example, if Bijay sell goods to Vinay on credit, Vinay's account will be given debit in books in Bijaya's books and he is receive of goods and Bijaya's amount will be credited in Vinay's books. So the simple thing is that in personal account, debit the receiver and credit the giver. Second is real account. These are accounts of assets. Asset entering the business is given debit and asset leaving the business is given credit. If asset is increased, we should give the debit and if asset is decreased, we should give the credit. For example, when goods are sold for cash, cash account will be given debit as cash comes in and goods account will be credited as goods go out. So the rule is debit what comes in and credit what goes out. Number 3, nominal account. These accounts deals with expenses, incomes, profits and losses. Account of expenses and losses are debited and accounts of incomes and gains are credited. For example, when rent is paid to the landlord, rent account will be debited as it is an expense and cash account, real account will be credited as it goes out. Similarly, when commission is received, cash account will be debited and cash is received and commission account will be credited as it is an income. Thus the rule is debit all expenses and losses and credit all incomes and gains. That's all.